Good morning, good afternoon, and many thanks to Super Return for hosting. My name is Claire Commons, and I'm head of strategy here at Palico, the private equity investment platform. Palico is a place where investors come to source new investment ideas, sell assets on the secondary market, and be inspired by stories of leading investment voices on our podcast and webinar, just like this. Our members include thousands of institutions actively investing in and divesting of private market investments. A key segment of our member base is endowments and foundations. And as a category, E&Fs, endowments and foundations, as you know, include some of the most sophisticated and prominent institutions out there. And they have been long known for successfully generating outsized returns. Now, in 2020, E&F investment portfolios are being relied on even more to support underlying operations that are crucial for their success. Well, I am willing to bet that you, like me, are feeling a little bit of Zoom fatigue. So we wanted this conversation to be a little more fun and a little more action-oriented. So unlike standard webinar discussions, we'll actually be asking our three guests to give three most important decisions that they think their peers should be considering right now. We'll focus on key takeaways as it relates to the investment side, the top program level, as well as tips for how to work better and faster and make smarter investment decisions with the team. So we got three guests in the three categories, which leaves, that's 3 times 3 is 9, that leaves one more. So I'll throw in a surprise one at the end. And then we'll leave a little more time for your questions as well. And before we begin the heart of the webinar, I just wanted to remind you that nothing on this webinar that we say, me or the guests, should be seen as financial advice. All opinions expressed by me and my guests are just our own opinions and not to be relied on for the basis of financial decisions. Okay, now I want to briefly introduce the guests, which you can see on the screen there, and share a little bit about the organizations. And I'm impressed we all kind of look like our picture, even though we've all been in confinement for a year, so good on us. So first up is Abigail Archibald. She's a senior portfolio manager at the Mellon Foundation, which is a $6 billion foundation, and she manages the foundation's private asset portfolio. Mellon Foundation was founded by Andrew Mellon's children and gives approximately $300 million each year in grants to grantees in higher ed, arts, and environment. So Abigail is going to highlight some key decisions that grant-making foundations should consider to ensure that their investment portfolios best support the grant-making programs and vice versa. Lisa Vazquez is portfolio manager at Mass General Brigham, which was formerly known as Partners Healthcare. Mass General Brigham has a total portfolio of over $13 billion, and that includes the endowment and pension fund and operating assets as well. It's a hospital system of 16 hospitals and sees 1.5 million patients annually. I looked that up on Wikipedia, so it must be true. And another fun fact I discovered was that the first full face transplant was done at Mass General Brigham, and the first place to have the full sequencing of the human genome. Back to investments, though, Lisa will discuss some investment decisions the hospital has made this year, and how, when sometimes changing nothing and sticking with your guns in the face of even global chaos can actually be the smartest decision. And finally, we have Kristin Reynolds, who is partner at NEPC, and where she co-leads the firm's E&F practice group. And as you probably know, NEPC is a client base of over $1.1 trillion. That's trillion with a T. And historically, they have had a lot of public pensions and renowned corporate pensions, but actually their E&F practice is quite sizable as well. So Kristin and her team works with approximately 100 E&F clients with roughly $80 billion under their roof. So I'm looking forward to tapping into Kristin's unique vantage point because she works with a multiple different kinds of clients. And that's really what I want to tap into, is how the decisions that her clients make, there's really no one size fits all for any of these decisions, and how important it is to carefully craft an asset allocation that actually matches the unique goals and needs and issues and concerns of that organization. All right, let's get to the question. So first, we're going to talk about the investment program, and I'd like to start with Abigail, and I want you to share. When we talked before, we talked about how the Mellon Foundation has recently made a pretty big increase in spending in terms of grant giving, and how that has affected your actual investment decisions and investment program. So maybe you can talk about your experience, a decision that a grant-making foundation should make in this time period where probably a lot of institutions are looking to tap into the funds for investments to really support their very, very needy grantees.
Sure. Thanks so much, Claire. And it's great to be with all of you. The Mellon Foundation in March decided that this was a period of time where our grantees needed us that much more than in regular times. So we announced publicly that we were going to increase our grant budget from $300 million in 2020 to approximately $500 million in 2020. And I think our team really needed to think about what implications that was going to have on how we positioned our portfolio. We have a big portion of our assets in alternatives. And so I think with additional spending, we felt we need to be paying even closer attention to the liquidity in our portfolio. And so that meant being very careful. We have certain guidelines that we have in place for how much we'd like to be committing to some of our private managers in a given year. But I think the renewed focus on liquidity meant that we were paying even closer attention to those commitments and making sure that everything was meeting the highest bar possible. So it meant we actually ended up declining a couple of funds that were being raised by some of our good, but not best longstanding managers in our portfolio. And it also meant that my colleagues who oversee the more liquid parts of our portfolio needed to use this time actually to make some hard choices and redeem from some longstanding managers where we didn't maintain a high level of conviction. So I think maybe I'll stop there, Claire, unless you want me to delve in further and we can kind of hear about what others were doing.
That is great webinar etiquette to not hog the first question. I like that. Not everyone does that. Yeah, let's stop there because I think I want to move on to Lisa because when we were talking about the Mass General Brigham portfolio, what struck me so much from an investment perspective is this sense of actually for that program, the best thing actually was to not make any changes and having the courage to continue to do the same, adding to the same amount in your portfolio and really continuing to be consistent and how that can actually be a competitive advantage and how different that is from Mellon, where you have made some major changes in spending. So Lisa, why don't you talk about how the decision-making process you have this year to say, well, actually, for us, the right thing is to continue what we've been doing.
Yeah, thanks, Claire. So to the credit of our team and really what is a very sophisticated investment committee, we had spent the time a while back just talking about what the next crisis or financial downturn would feel like and what our plan would be. And we reminded ourselves that we have a long-term orientation and that our advantage would be patience and consistency and maybe using it as an opportunity to grow with some of our key relationships. So we've always known that we can handle volatility and that it's important to invest across cycles. That's not to say that we haven't had to make some really tough decisions in the portfolio. The crisis this time was different because it was a global health pandemic in addition to a market disruption. And so for us at Mass General Brigham, that was even more of a challenge. It hit our operating portfolio really hard on the hospital side. And we're not used to having to fund the operations of the hospitals during a normal setting. So on the liquid side, we had to make some redemptions from the long-term pool to meet those capital needs of the hospitals. Historically, we usually use that capital to fund, long-term capital projects. So yeah, I mean, we feel like sometimes you want to do something, but I think smart investors in this environment on the private side can really take advantage of patience and consistency in a long-term perspective as a competitive advantage.
And now let's turn to Kristin at NEPC, and we're going to kind of go up a little more bird's eye view and also think about across lots of clients, because obviously you have the benefit and the sort of position of talking to multiple different clients. I think there's been this idea over time that this, David Swenson Yale endowment model is really that's kind of the be all end all. And I think I'd love to hear your perspective on how this crisis has actually helped you consult and advise to some of your clients about, well, actually your asset allocation might need to be tweaked this way or that way because of the way that your program funds certain operations or some other things like that.
Sure. I think Lisa and Abigail have already highlighted this, that the not-for-profit world is large and it consists of many different types of investors. Just think of three. So foundations, universities, and healthcare institutions. We hit a global pandemic and continued discussion about racial inequalities all in the spring, and each of those were met with different responses. For universities, the pandemic was the largest impact on their portfolios. They were worried about getting students back to school in the fall. And so they were thinking a lot about cash flows and raising money from their endowment in the near term, just in case they needed to support operations in the fall. Lisa said it, the operating pools for healthcare institutions normally fund long-term capital projects. Today, in the spring, they're being used for funding the hospitals near term. And then foundations actually saw a lot of cash flow positive fundraising in the spring as racial inequalities brought more money to many of the foundations across our country. So when we talk to clients about asset allocation, we're really helping them focus on the cash flow nature of their organization over a long period of time. And that really does change how they should allocate their assets. So the operating pool of a healthcare institution looks very different from a university, and even a foundation who normally isn't a cash flow positive investor to the extent that they've been recently needs to peel back a little bit further away from that illiquidity model described by the Swenson model. So I think it's really interesting to think about the nuts and bolts that drive the investments rather than thinking about how other investors are investing their portfolios.
One other thing I was thinking about that is kind of loops in with the investment side, you were talking about some of the thematic investments like healthcare, and today on the news, it's been in the news a lot, is Tesla being now part of the S&P 500, and what an enormous disparity there's been between some parts of the portfolio and others like tech. And I know some endowments and foundations and hospitals have ended up having a very some dichotomy in their portfolio between the tech, growth investments and some of the more kind of stable cash flowing later stage private equity. I guess the last piece before we move to the program, Abigail, back to you. Has that been something you've seen in the Mellon Foundation portfolio, and how have you managed the, keeping the balance between some of these very strong performing tech investments and then the rest of the portfolio, given the huge increase in valuations?
Yeah, it's an interesting point because it's actually something that we've been seeing in our portfolio even before the COVID crisis. We had seen tech become an increasingly larger portion of our private equity portfolio as late stage venture valuations increased, but also as many of our buyout managers were also active buying software businesses. So we had seen that, we had been mindful of it, I think even coming into March, but you're right. Valuations have sort of, there's been an even further divergence. So I think it's something we pay close attention to. And I would actually broaden, I think the other thing that's come through during the crisis is it's not just the tech businesses where we're seeing a real divergence in valuation. I would say it's the technology businesses, but also healthcare, whether that's healthcare. Some of the healthcare services maybe are an exception, but healthcare IT and also life sciences companies in our portfolio, and life sciences services companies, where we've seen the valuations of those businesses really diverge from some of the others. There's not that much, I think, that we're doing about it, but we're very mindful of those valuations. And I think we just continue to observe what our managers are doing. I don't think it's caused us yet to take any action, but I don't know if maybe others have actually done anything or been a little bit more active in terms of managing the valuation dispersions that they're seeing.
Well, I think that's an interesting segue into our discussion about how the investment program intersects and interacts with the kind of more institutional level, the program piece. And you were talking about healthcare, and let's go back to MGH, Brigham MGH, excuse me, with you, Lisa, and how that, the biotech and healthcare generally has, I'd say, been obviously a place that you feel like a sense of expertise and knowledge and understanding, and how that kind of cultural, historical perspective, has that guided your investment decisions? Do you feel like relative to your peers, you have actually more healthcare and biotech and life sciences in your portfolio? And are you comfortable with that kind of bias given the kind of cultural and kind of organizational expertise?
Yeah, so at Mass General Brigham, we are very bottom up in our analysis as we think about managers. And we think that if we invest with best-in-class managers, they'll lead us to the best ideas. One exception as we think about concentration across the portfolio does relate to biotech, and it's not because we're out there necessarily hunting for biotech and needing to really increase our allocation there. It's mostly because we've gotten tremendous access to really the best managers globally. So we do have quite a bit of biotech exposure, and that feels right for our system given our expertise.
Great. Well, why don't we let's talk about some other decisions that institutions should be thinking about as the year ends, and as we're thinking about how the program level interacts with the investment level. Kristin, if I can turn to you.
Sure.
What are some of the decisions that you've seen clients make, or choices they've made, to be thinking about levers that they can pull to manage cash flow? Obviously, as we talked about earlier, we can draw on the endowment, right? We could cut back on programs, but are there other sources that you've seen, other decisions that your clients have made to be more creative? Are there other tools in the toolbox that you've seen some institutions make to kind of manage that?
Sure. So through the spring, I think a lot of people were curious if peers were raising their spending rate, specifically giving more to the university, giving more to programs. It's interesting that we didn't see much of the increasing the spending rate, but we did see a lot of creativity. And we held two roundtables in the spring with different types of investors. And the few things that we learned were there was a rapid deployment of technology, and they were taking a risk to deploy that. But they knew that they had to do that in order to continue developing their programs. So one foundation decided to start in March using text messages to raise capital. It was a way that they hadn't fundraised in the past, and it was wildly successful for them. And they got a lot of small donors. So that was very fun for them. Another foundation called all of their big donors and said, do you want to increase your spending rate, and by how much? And most of the donors were cautious about doing that because they were worried if they spent more this year, whatever, and they were worried that the pandemic would go on longer. And so what that organization did was they said, why don't we just speed up your distributions? We usually distribute in December only. What about if we do 1/3, 1/3, and 1/3 in April, July, and then again in December? And that allowed people the time to think about where their donations were going, but also get donations out immediately. We saw a lot of creativity around technology as well, fundraising via Zoom. Conferences like this are now via Zoom. So I think being able to take a risk and being creative was really successful for most institutions.
I think we're all having to figure out how to do all these things better. Obviously, we can't wait till we can go back and do things in person, but I do, and we'll get to this on the team side as well. But I think it's really cool to think about the different ways that people have been creative. And this is not about fundraising, but I've definitely seen museums do a better job about having, virtual tours of the museum. And even I think I saw one where originally this was for people who have trouble hearing or trouble seeing, but doing a description of the inside of the museum and having other people listen to it on a podcast or something. So there have of course been a lot of dark and dull days this year, but I think it's been wonderful to see the creativity and resilience that a lot of nonprofits have seen, have experienced and done in the face of 2020. There was another, we didn't talk too much about universities, Kristin. I know you have some university clients, and I think kind of the headline, a lot of universities have been challenged, right? Because the tuition inflation in the U.S. has just skyrocketed in the past 20 years. Obviously, the very, very sort of renowned ones have big endowments, and the ones in the middle have been challenged. Have you seen for your endowment of university and colleges, have you seen them react in a way or decisions they've made that you feel like you can share that are interesting?
Sure. So universities, around July, it was predicted that enrollment would be down 20%, which would have a big impact on operating budgets. And arguably, parents wanted to keep their children local where they could. When school actually opened in September, enrollment was down like 15%, so less than what they had projected, but still significantly down. What universities did was they enacted their 10-year strategic plan. And so in many of their strategic plans, they were already trying to envision what college would look like in 2025 or 2030, because they felt like brick and mortar institutions didn't meet the needs of all students. And so where they expected their student base to be via video, and increasing over the next 5 years, they were capable of turning that on pretty rapidly and still offering programs that are important to be in person. So I think about my daughter, who's not college age just yet, but she wants to go to school for dance. You have to have dance in person. You have to have science labs in person. You need to do sports in person. So they use their endowments and their spending this year to really shore up keeping children safe, but also fast tracking their 10-year plan. So I feel like the changes that we made to universities this year are probably pretty sticky. Great.
And now let's finish up this section on the program level with Abigail at Mellon. And I think it's been a I'd say a very smart decision that you've made at Mellon to connect the program level work you do at Mellon with your investment managers, and maybe you can share how you some things you've done to strengthen that connection between the sort of work that Mellon at the institution does with the investors, the investment managers in your portfolio.
Yeah, we did take the opportunity over the past, I guess it's past 8.5 months, to try to remind our managers about the work that the foundation does. And I think it's been in many situations in small ways. And I'll give one example. At the end of March, we received a sizable distribution from one of our growth equity managers who sold a publicly traded position, a company that they'd taken public the year before. They made a sizable distribution. And I think I alluded to this earlier, but we were paying very close attention, and we have been over this entire year, to our cash flows. And so a sizable distribution to us meant a lot at the end of March, when we decided to make some emergency grants in the New York City area. So the day we received that distribution, I sent a note out to our manager just to say, wanted you to see an example of the kinds of things that this particular distribution can go to support. And so I sent them to a link to some of the emergency grant making we were doing. And the partner wrote back and said, actually, I serve on the board of that organization. This really means so much to me. And then the investor relations person wrote back this with the entire firm in the town hall that's taking place later this week. We really appreciate it. It's helpful for our investment professionals and all of our support staff to see the kinds of grants that our investments allow us to support. And so that felt good for everyone, but I think it just deepened the connection between us and our managers. And we've done that on multiple occasions now subsequently, even just before Thanksgiving, when we got a sizable distribution from one of our buyout managers, and really just took a few minutes to thank them and remind them of the work that those kinds of distributions allow us to support.
No, I think that's a really good story, and it's I think a smart and kind of useful thing to be thinking about, and a tool that investors should remember, because at the end of the day, especially in the private equity world, sometimes there are more hands up than spots available at the fund, and so having that extra piece of the story explaining how meaningful the investment is to the program, I think can make a big difference. And, we're all people, and we're not just numbers on the page. And so kind of having that personal connection and providing the story, I think can make a big impact. Well, good. Well, I'm going to switch gears to decisions we can make as a team. How can we become better investors as a team? But before I do that, I want to draw your attention to the Q&A section down at the bottom. Mine is at the bottom of my screen. And so definitely feel free as we're chatting, and if there's something that one of us said that you want to kind of dig into a little more, or there's a question you have, please feel free to add your question there, and we have saved a few minutes at the end so that we can dig into some of those questions. So please take a look at that. Good. Okay. Well, now let's turn to the section about key decisions that we should be making as a team. What decisions can we make that make us a better investment team and better investors? And I think it's always important to be thinking about, organizational dynamic as it affects investment decision, but especially now when I know lots of us have onboarded new colleagues completely over the internet, and we haven't seen our bosses in months, and it's all so difficult. And so what I'd like to do is to offer a few suggestions, a few tips, a few things that E&Fs should be thinking about that can be really helpful. So why don't I start with Lisa, and why don't you talk about some of the decisions you've made that have really helped actually make your investment decision better, because it has been able to include more voices and have a fuller investment process, including more of your team.
Yeah, absolutely. So Mass General Brigham have shifted over time towards a more generalist model, which means that every illiquid investment is competing for the same capital. And the person who maybe used to lead a relationship now needs to figure out a way to really include other portfolio managers in the decision-making process and really put managers in competition with one another. And in an environment where everyone can attend the annual meetings, which are now remote without the travel requirements of, going to see a manager in person, you can get a lot of people taking part in a Zoom meeting. And it's really sparked some great discussions that we think will result in better investment decision-making longer term.
So you feel like now it makes it so that there are more voices that have been able to influence a decision. Is there a specific example where you feel like, well, gosh, I wouldn't have thought of that. I'm really glad my colleague who normally thinks about, corporate credit or something added a lot of value?
Yeah, I mean, it happens all the time in our portfolio now where, it isn't until you stack up a credit manager against a venture manager, or, you think of all the different combinations of managers you can kind of put head to head. And once you arm people with the information of being able to really dig in on a manager, they're kind of able to advocate for one manager over another. And it's really generated some really interesting outcomes.
Great. Well, why don't we now turn to you, Abigail? I think I would consider you to be an expert in making things work digitally. So I'd love for you to share some tools and some decisions your team has made, both digital and non-digital, to make for better collaboration, especially right now. Like, what has made your life easier? Please share with everybody.
Sure. Well, I don't know if you wanted me to get into this one point, Claire, but I had been working, I'm based in London and the rest of our team is based in New York. So I had been working remotely since August of 2019 and had come to rely a lot on Slack. Which our team has really started to use both for project management. So if we're doing due diligence on a manager, we have Slack channels, but also as sort of an instant message, and not necessarily even instant message, but messaging, but one-to-one messaging or group messaging. It doesn't have to be instant. So that's become a tool that I think our team relies on greatly and has enhanced communication. I would also say, and this is digital, but is basically, Zoom meetings, Zoom for internal meetings has also become really valuable for us. We realized that we actually had a number of analysts we had two who started remotely in March and one who started remotely in September. And we realized that there just weren't that many opportunities for them to chat both formally and informally with the team. So we have many more frequent check-ins as a team than we had previously. That's been very helpful. And I think we've also done a lot more one-on-one conversations or smaller group conversations just to make sure we're getting to know one another, but Also to give our newer analysts opportunities to ask the question that normally they would turn around and ask the person next to them, how do you do this? We're trying to give them a little bit of a forum to ask those questions. So we've used Zoom for that. We use Slack, as I mentioned, but we actually also, in addition, and I'm not sure you want to have that many tools, but we also use Microsoft Teams for video chat.
It's interesting. Tech tools, obviously, Palico is a digital tool, and we've been helping investors, digitally way before the pandemic. We've actually seen a huge increase in both, investors looking to sell their assets on our secondary market, and also people being curious about connecting with GPs on the primary market. And I think Palico is one example, but you've definitely seen a lot of news about private equity funds raising a lot of money, 100% digitally. And so I think Palico is an example of a company just like you. We've been doing this digitally, way before COVID, and same as you. You've been able to manage your investment team remotely. And I think it's really interesting to see some of the tools that investors are using now. They're just relying on more. And yeah, I think that's pretty exciting, because I think there's ways of making our investment decisions even better, incorporating some of the tools that we can use into our decisions. I guess on that, let's now move to Kristin and kind of think about, from your perspective, what are the decisions that you've made now as a business? I'm thinking of you as kind of interacting with clients, and you as the lead of the practice group. Which business processes have you done that you've been forced to do now because of COVID? What decisions have you made that that when things go back to normal, you're going to want to adopt them? And I think before you answer that, I do remember, sometimes I think we've all had this experience of, before COVID, you go to a meeting live, whether it's an on-site diligence with a manager, or if you're a client going to a client, you think, gosh, I had this 1 hour meeting and I just wasted 2 days, and let's not talk about the carbon footprint and the cost and the fact I can't see my family. Whereas if I had some tool set up to do this properly, I think I could do it pretty well without having to get on the plane and go somewhere. So what's it been like at NEPC? Because I know doing things digitally will have been a big change, not being able to see clients face to face. So what decisions have you made that you've learned from?
So if you just think about our business, we are in a trust and knowledge business. And knowledge usually gets disseminated during normal working hours for the most part. And trust is something that's 24/7. And when you can't see somebody in person, that trust really starts to erode. And that knowledge starts to spread out further and further. So the two things that we did from a client basis was we years ago built a client hub portal where our clients can access a lot of their information right on our client hub portal, including some manager write-ups. And the usage, now just think about what people were doing in the spring. Maybe I could work 8 to 5, but some of my colleagues had to start working at 5 when their wives were done working for the day, and they would work at night. So there's children in the equation. So our client hub portal, it tripled in usage between April and October. So people were on all hours of the day, getting the information they needed on demand when they needed it, and not waiting for an email from somebody to send them the knowledge. So the access to the knowledge shifted. Then also the idea of, I call it crazy hair, don't care. people calling me on Teams and having their video up. And these are people that I'm used to being in my suit for. And they were just like, oh, hey, how are you doing today? And that trust was built in a different way because they could see my background and ask me questions about my family. So I think we shifted the way we trusted each other as well, which has been so enlightening. I think when we go back to a regular normal, and the crazy hair won't play anymore, but certainly I think people feel very comfortable talking on just a Teams meeting or a Zoom call pretty briefly. For my team, I think there's a lot of research out there now that these interactions are important so that everybody gets a voice. And what I've noticed, and Abigail and Lisa said it as well, is when you have people on a video conference, instead of dialing into a conference, instead of just dialing into a black box, people feel more comfortable sharing their voice. And we've heard from people this last 9 months that we didn't usually get to hear from because they would put themselves on mute. But now intensely, they need to be engaged and they're willing to offer their opinion. So I think, again, rapid use of technology, deploying technology and giving people the access to the information when they need it and how they need it was really important for our business.
I think there's a lot there that's very interesting, especially on the way that sometimes video can make things more personal. And you're right, there have been more people have seen my living room and bedroom than I normally, and my children, my husband normally see. But I think that's a really salient point about providing a little more equity into getting different voices around the table that are heard in a way that with the phone and definitely in person there wouldn't be. So great. All right. Well, now
I was going to add there.
Yeah, please add.
I was going to add just to what Kristin said, which I think is interesting, is none of us actually thought about having to train people to use some of these digital tools. And to Kristin's point, we actually had to say to a couple of the analysts on our team, please make sure you put your video on when we're doing calls with managers, because then you'll be more inclined to ask a question, you'll be more inclined to be heard, and you'll feel more engaged, and you'll be treated as a more engaged member of the meeting. So even just doing a little bit of training around how to use Zoom and video even better is something that I don't think we anticipated, but something we spent some time doing as well.
Well, I want to pick up on what you said about training and trying new things. To go to we had sort of 10 things for 3 for you each. And I want to bring up one decision that I think is really interesting for E&Fs to consider. And that is trying something new. And the trying something new is to be thinking about how you can more actively manage your investment portfolio. And I'm at Palico, and I joined because I think what we do is great, obviously. So this is a little bit of a cheap ploy, but it's something I believe in. That when you think about your colleagues, if you're sitting in the private markets team and you think about your colleagues in the public side, they have 3 tools in their toolbox. They can buy more of something, they can hold it. So buy more is kind of re-up, hold it is just kind of let it go. And they can sell it. And so I encourage investors listening to this to really make a decision to think to be more active in your portfolio management, because there are some funds in your portfolios that are old, that are tail end, that are not core to your investment portfolio, that don't match where you are in the manager journey. Maybe there are relationships that you liked 10 years ago and they're perfectly fine, but they really aren't kind of what the future holds for you as an organization. And I think just as Abigail was saying, it takes a little training and it takes a little time. So that's why at Palico, the way we have designed our secondaries platform is it is completely free. It's free to join, and you can try it. You can list a fund for sale. You stay anonymous, and if you don't like the prices you get, you don't have to sell. And we have the whole universe of buyers who are active on Palico. And on average, they get between 5 and 15 requests. And we have seen really the more active and thoughtful E&Fs, come to Palico and say, hey, I want right now to make a decision to be a little more active in my portfolio. And so my 10th thing that I'd like everybody, as we wrap up the end of the year, to be thinking about is to take the secondary challenge. And that's the decision to really look at your portfolio with a more active and keen eye. And whether you're an advisor, talk to your clients about whether there's some assets in the portfolio that really should be considered to sell. And just think about it as a tool in your toolbox. And so that's my surprise 10th thing. And really what I'm hoping is that my point combines the element of an investment decision, right? Also, thinking of it more as a program level, and then as a team decision about how do we think about making investment decisions better as a team, and how do we use new digital tools? And that's really what Palico can do. So that's my surprise 10th decision to make. And now I'm just looking at the clock. I do want to open it up. To questions. And the first question we got that I think we touched on a little bit. And I'm going to start with Kristin, but then other people can join in because I think it's a really important topic that the people are thinking about. Is to what extent has the kind of current situation impacted E&F's demand for impact sustainable related strategies? Has it made people think, wow, COVID is like the dress rehearsal for all these environmental issues? Or has it made people kind of say, well, let's retrench and focus on kind of the meat and potatoes? What has been your experience?
So I'll answer that two ways. First, we have a lot of clients asking questions about what's currently in their portfolio as it relates to impact investing, specifically ESG, so environmental social governance, and how their managers stack up in terms of the ways of the future. So absolutely, we have heard more from clients and have, developed a tool over several years to help answer that question for clients, what's in their portfolio. But importantly, I think the wave that we've seen in terms of just new opportunities coming to NEPC has really been around two things: diversity, equity, and inclusion. So think about what happened in the spring with racial inequalities. It's really come to the forefront in a way that hasn't in the past in investments. And then secondarily, again, in ESG scoring. So people are really focused on, just like you said it, Claire, the future and how they are going to make an impact. And what's interesting about this is endowments and foundations have always had this as sort of a baseline thought in their portfolio. They are actively pursuing ways to change their programs today. We talked about Yale earlier today, but even David Swenson came out and said, this is the way of the future. And he's right. We've heard much more about this topic, much more interest in this topic in the last 8 months than we have over the last several years.
I'm actually just looking at the questions, and I see basically there's a lot of questions sort of on that topic. So yeah, I think if Abigail or Lisa want to chime in on how you guys are incorporating sustainability and how that's changed if that's changed kind of in the past year.
Yeah, maybe I'll just say that I think that if environmental, social, and governance issues are already integrated into your due diligence process and monitoring process, that doesn't change regardless of the financial environment. And so, it's something that has been important to us as an input that drives financial returns, always long before this. And I think that, some of the issues such as the social have really been amplified during this time period. And so we've really zoomed in on things like manager diversity, which is important to us.
Great. Okay. I have one from
I'm happy to add.
Please go, Abigail.
We have sorry, I think I'm on my computer's on delay. I was just going to add, I think from our perspective, we've been focused on thinking about the diversity of the teams that we're backing for many years now. So I don't think that there's been any change for us in the recent months. We continue to think about the diversity and the inclusivity of the managers that we back. I will say one observation with respect to our managers is we had seen our European private equity managers for many years be very proactive about sharing what they're doing on the ESG front. So we've been seeing that for years. And the one thing we've noticed over the past 6 months in particular is that many of our US managers have now hired somebody to think about ESG factors or sort of the potential ESG impact of some of the portfolio companies that they're backing. And that's been something that's new, where we've seen sort of very traditional buyout managers hiring somebody to focus on this and to think about this for them, which it was sort of an interesting trend, I think.
Great. I want to switch gears to a completely different topic, which is inflation. And I mean, interest rates have been low for so long, but obviously there's been a lot of stimulus, basically printing money recently. There hasn't been inflation, and a lot of endowments foundations that put together a thoughtful kind of real assets program, timber and all sorts of minerals and tips, which is outside of alternatives, that really candidly hasn't been such a success, right? So I guess the question here from the audience is, now is an inflation concern for you and your programs? And if so, which specific investments in your alternatives programs are you thinking about to kind of address that? And whoever wants to answer, that's fine. I don't know, you want to go, Lisa?
Apparently, I drew the short straw. Yes, inflation is something that is always on our radar.
There's no inflation in hospitals, I'm sure. There's no inflation in healthcare.
Inflation is something that has always been on our radar, but there's nothing in particular on the private side that we're doing to actively address it in the private's portfolio. We're not, doing more of the real assets aggressively. I think we have done some of that in the past, but hasn't been super successful. So not looking to address it on the private side.
And so, Claire, I'll answer that holistically as well, as we're less worried about inflation today. And I think there's a good argument, both from a technology standpoint, but from, sort of a debt standpoint that, we don't have a lot of inflation on the horizon. And we agree with Lisa. It's part of something that you're always thinking about, and the painful kind of inflation is the surprise inflation. And so in those cases, what investors have done and continue to do are think about places in the portfolio where that change in inflation could be most impactful. And most recently, that was more equities, because that's where we saw the inflation in portfolio. So I think redefining what low inflation and surprise inflation means is more where investors are spending their thoughts.
Great. Maybe we wrap up with a little bit of a due diligence question from someone who asked, okay, well, how the heck do you deal with these first time meetings when you meet with the manager? We're not going and meeting them. Does it make a difference? Are you feeling stressed about doing this over Zoom, or how has that been working for you? Abigail, why don't you start with that?
Sure. So we have been doing full-blown due diligence remotely since actually the beginning of March, and I think that we've learned from each time that we've done it. I think, and maybe this question is more about first time meetings. but I think with respect to full-blown due diligence, we've just learned that the cadence of the meetings is a little bit different, and maybe we have to stagger them a little bit differently. But as far as meeting people for the first time, we've been doing a lot of that as well. I actually think, in a way, I think some of us were worried that we wouldn't see as many prospective managers sitting at home, but it's so easy now, maybe too easy, for people to reach us and set up an introductory call. So we've been doing plenty of those. I think the question maybe that this person's getting at is, when can you make a commitment to a manager that you've met exclusively remotely? And we have not done that yet. We've had managers who we might have met prior to the pandemic, maybe not in their offices, but either in New York or in London. We met them for a first meeting remotely, and then we've gone and not closed anything yet, but have gone on to due diligence now. So we haven't done anything from start to finish yet that's been exclusively remote.
I think that day is coming, probably.
Yeah, maybe just to chime in on that,
Yeah.
and maybe amplify what Abigail said, is that, I have trouble in a first time meeting doing it over just the phone, because I get so much out of kind of the face to face. And so for me, being able to do a first time meeting over Zoom instead of over the telephone really kind of opens up the top of the funnel. And I feel like I'm able to have more high quality first time meetings than I was in the past. And that has really been super helpful. And that's without, having to travel, even if it's just a quick trip to New York. So that's really been great for us.
Well, great. I'm sorry, I wanted to get one more thing in, but I think we're going to have to stop it there. We're nearing the end, and I know people have meetings coming up in 4 minutes, so like to end on time. I hope everybody's enjoyed learning from these experts that are so nice to have joined, and also that you feel like you've got a good list of actionable items, decisions that can really help you make smarter, more informed, and efficient decisions. So we would love to continue this conversation with you. I know there's a lot of questions we didn't get to answer, and really interesting discussions are just started. So you can actually see on the screen, there's a way to get in touch. And I think you literally like point your camera at that funny looking thing. It works. I've tried it before. And so we can schedule time to chat. And we'll also be following up with a little recap of the top 10 key ideas. So you can share with your team or put in your office or on your dining room wall, wherever you do your work. And then finally, you can see on your screen, there should be a resource list where you can access our podcasts and additional materials about both our primary and secondary marketplace. So I just want to say thank you to Super Return for hosting, and a really, really big thanks to our insightful and thoughtful panel. Thank you so much, and I hope you have a wonderful day, everybody.